Welcome back to the channel. So this is another GME video that we're doing. Is an update to the video that I made yesterday where I discussed how I made $174,000 in the last 30 days from GME. I also had some predictions as to how today was going to go post news. If once the news comes out that the offering was going to be completed. Now I had no idea that the news would be coming out yesterday afternoon. We calculated things in an Excel file. The Excel file did say that it should come out, and it did come out. We're going to talk about the positions that I put on right before that and what I did right afterwards. But before we do, let's discuss the elephant in the room, which is Roaring Kitty, Keith Gill. Did he get rid of his options today? Because in the last 30 minutes of the trading day, there were a lot of options hitting the market that were right in his strike point and also expiration date. Now, we're going to be looking at a few things here. We're first going to be looking at Think or Swim for the option data. Now let's look at the chain. We'll be looking at GME here. Let me scroll up. So he is June 21st, the $20, right? So look at the volume today. 93,000 contracts were traded just today, right? And we can just kind of put the open interest here. Now let's quickly discuss something. People online have been saying, well, the open interest has not changed, so that means he could not have sold. While the open interest only gets updated once, and we will only know tomorrow whether or not all this volume, or if the majority of this volume was options essentially being sold, okay? So anything regarding open interest, it's not relevant for today. We're simply not going to be able to use that data point to figure out whether or not these options were bought or these options were being sold. What we can do, on the other hand, we can chart this up real quick, okay? We'll look at it over here. This is the 1 minute chart. So what we're seeing here, there we go, is the price of these options throughout the day. I'm also going to do one other thing. Let's get rid of this. Okay. Alrighty. So this is the value of these options through the last couple days. We can see at one point it hit a peak of $28, right? Today we had a peak of $14 for these options until towards the end of the day. Notice what is happening here. Notice this volume, as a matter of fact. Compare this volume to the last couple days here, right? It really sticks out, doesn't it? It really sticks out. Last 35 minutes or so, right? Just starts getting green. Now, obviously, the stock price is also dropping when this is happening. But once this volume became apparent, right? Look at this: 7,000 contracts, 12,000 contracts, 10,000 contracts, 6. 4, right? And at the very end, we had 17,000 contracts traded, right? This is not normal, right? If we pull out and look at the hourly, this is the hourly, and look, this is over the course of the last month. Look at how it looks like over the last month, right? Again, it sticks out quite a bit here. And over the 4 hours, notice what's happening here? This is where Roaring Kitty bought his options, right? We can also see the volume here. We also remember those days. I discussed this in the previous video. When he was buying those options and people were posting about it on Twitter, we saw the stock price going up. Today we saw the exact opposite. The options being sold and the stock cratering lower with every single volume being hit. Back then, what was it? May 21st, May 22nd, we saw the volume come in and we saw the stock going up. For those unaware, typically when you are transacting with a market maker, and let's say I'm buying calls from a market maker and they fill that order, they go and they hedge that right away by buying shares on the market. That is what they do. Now they do a thing called delta hedging, meaning that, if I buy a way out of the money call, they're not going to go out there and buy a share just because I bought one call, because the delta on those calls might be so small, meaning that if the price fluctuation of the underlying, let's say GME in this case, has a very small effect on the value of those options. Now, thanks to gamma, as gamma increases, the rate of change of delta increases also. So at some point, the delta gets more substantial. As that delta gets more substantial, that is when the market maker adds more to their hedge. So they're not hedged completely off the bat, unless, let's say, you're buying a very deep in the money option that has a 1 delta, very little extrinsic value. In that case, yes, they match it 1-to-1 in terms of share to option share, okay? Quick little lesson there. So that's why sometimes we see this. We see calls being bought and we see the stock price going up. That's because of the hedging being done from the market makers. And there could be a feedback loop here where if the price continues to go up, they do have to hedge the previous positions even more, which is why we hear about this gamma ramp and so on. Anyhow, we saw price going up back then. Today we saw price dropping. Okay, that gives us a hint that these options are being sold into the market. Okay. The price here was 640. Okay, let's pull away from this for a split second. We'll look at his position real quick. So again, 120,000 contracts is what he had. Now let's look at unusual whales. They do have a software here. They show us the open interest of 170, right? That's what it was up till today, right? We do not have today's data so far. So 120 out of 170 is Roaring Kitty's options. Okay, the volume today was 93. Now here's the important part. The bid was nearly 60,000. Now, why is this important? Well, when you're putting a market order in, if you're selling and you're putting a market order in, you're selling at the bid. If you're buying something and you put a market order in, you're buying at the ask, okay? That automatically happens. Normally, if you're taking your time and you're buying something and you're not doing a market order, you're putting a limit order, you're typically doing a midpoint order. In that case, you basically grab the midpoint of the bid and the ask, and you're trying to split it in half and see if there's any takers at that point. When we see the bid being 11,000, we can't really tell whether or not that was someone buying or selling from a market maker, right? The majority of time when you're getting an option filled, by the way, it's almost always a market maker. It's not some Joe across the street. 95% of the time, if not greater, it's always a market maker, okay? In this case, with the mid, we can't really tell whether or not that was someone buying or selling from a market maker. If it's a mid. If it's a bid, completely different story. This is someone selling something to a market maker. It's a market maker buying something from them, okay? 60,000 contracts were being sold to a market maker. And yes, 22,000 contracts were being bought from a market maker. Look at the bars here towards the end of the day, right? Last 35 minutes or so, we see these massive red bars that's selling to the market maker, right? That's where that's occurring. We see some in the mid price here. Now, when you look at this data, you have to be asking yourself, there's only two options here. It's either someone that owns a lot of calls, sold it to a market maker, Roaring Kitty, or someone with a lot of money decided all of a sudden that they want to start writing $20 call options, okay? Just naked call options. They basically believe that GME will finish, let's say, below 20 bucks in the next 7 trading days, and that's what they're doing, and they simply wrote these options, the market makers bought them from them, and so on. That's the only two options. It's either someone with big pockets decided to write these options, just all of a sudden at the end of the day, last 30 minutes, block orders, humongous orders, market orders more importantly. Let's remember, these are market orders. This is someone just trying to get the hell out. Or it's Keith Gill. That's it. We can look at this image here. Someone on Reddit essentially took down, these are all block orders. So these were just one order after another. 5,000 contracts, 5,000 contracts, 5,000 contracts, right? If we count this up, that's 10 transactions that were had for 50,000 contracts. Notice how we have 59,000 contracts traded at the bid here. This could be other people followed. This could be other people looking at this happening, being like, get me the hell out, right? Because a lot of people did still piggyback off him, right? There is an open interest of 170. Right, he's 120. So there's still 50,000 contracts out there owned by other people. So someone could have seen this and said, "Hey, listen, get me out." It could have been 9,000 of them. It could have been some people that bought the ask and then went off and sold it right away as a market order. Right, it could have also been that. As we also look here, right, it's every 2 minutes, 3 minutes, 1 minute, 7 minutes. It was sold pretty aggressively, and almost every sell was almost worse than the previous ones. Well, at the very beginning, they sold for about 765 or so. Now, if I haven't made it clear yet, I'm of the mind that, yes, this was Keith Gill. He was selling his position. We did see GME having a little bit of a rough day. And as I mentioned in my video from yesterday, I kind of expected. I actually said yesterday that, hey, when the completion of the offering comes out, I expect yesterday's move to be faded because too many people bought in expecting the offering to end and for there to be a pump. Way too many people, no matter where I turned, everyone's mom, everyone's sister, brother, on Reddit, on YouTube, influencers were saying, get in now before that offering is complete. Okay? So it became pretty clear to me it's going to be a sell the news event. massively, which it turned out to be. We did see a little bit of an intraday rally up to 33, and then here's the dumping, right? And then we saw right about here, where is it? Yeah, just about at about $30 mark. Oops, I'm sorry, I'm actually got my time zones off. Right here, this is the 3 p.m. Eastern time mark, right? Just about here, right under $30 either way, between 28 to $30 is when we saw these contracts hitting the market, right? A little bit bounce back, end of day. That's when we saw the contracts hitting the market, right about here. Notice all the selling pressure that came along with it. I mean, we actually were having a rebound here, you know, right before we began to dump like crazy. And I did check, if I'm not mistaken, I did check a little earlier in that day, and I did notice that, where is it? We can look at it here. So these options, you know, before the dumping began, and before that rally, let's say, these options were worth about $9. And as we saw, he paid, what did he pay? He paid about $9. He paid about $5.67 for them. Okay. And we can also see that the average price transacted today for that option was $7.65. So if it is Keith Gill and he did get out of these options, he did get out of them for a little bit of profit. Now, what he does next is going to be interesting. He might only sell enough of them so he can exercise the remaining options. As it stands right now, if we go with the idea that 50,000 of these options were his, he has 70,000 of them left. Did he raise enough money from these 50,000 to be able to exercise the 70,000? And the answer to that is no. He was not able to raise it just yet. So what can happen from here is that tomorrow, well, first of all, tomorrow we see the open interest. That's going to essentially affirm whether or not it was him selling, unless he comes out and tells us himself. If he does, and then we see the open interest change, then we do know he sold. Okay. Question is, does he sell more to the point where he can exercise a little bit of it? Maybe he can exercise, 30,000 of his contracts. Remember, if he was able to sell his contracts for more money, he would be able to exercise more of his contracts. Just for simple math here, if GME was trading at $40, let's say come expiration, $40, that would mean that the $20 calls would be worth $20, right? That's the intrinsic value at expiration, which means that he'll be able to sell one call option and then exercise another call option, right? So 50-50, right? If GME was at $40, okay? If GME was at $60, then he actually would be able to sell one call option and exercise 2 shares. You get it? So the higher GME was going to be during this rally, the more he'd be able to, well, the better the ratio would be. Now, the ratio is very different, though, when you come down here and you're selling them for $7.65 a piece. Because what's happening here, actually, is that you have to almost sell 3 shares, sell 3 options to buy 1 share, okay? And that's if these prices sustain. Who knows? Maybe the market opens up tomorrow and GME is trading at $23, $24. In that case, the ratio gets much worse. You might have to sell 4, 5, 6 option shares to exercise and get 1 share from the remaining options, okay? So he's in a tough predicament right now. Whether or not he does that, we have no clue, okay? He might just sell everything, which will also be very apparent if he does, especially if he's pretty clear considering how the block orders are coming in today. So that would be pretty clear if he continues that behavior. Or he might end up, selling 80% of everything and then exercising 20% of it. And then it comes down to how the community takes that, Is the community going to be happy about that? I'm not sure. Now, there are some people out there saying, hey, these were options that were bought. No, because again, we can see if they were bought, they'll either be at the mid, or they'll be at the ask. That's not the case, okay? A lot of this volume is strictly at the bid, not the mid, not the ask. Second of all, we would not see the price dropping as much as it did. Remember, when he initially bought these options a month ago, price went up when he bought them because it makes sense. Market makers have to hedge, they buy the shares, okay? If these were also positions that were being bought from market makers, same thing, price would not be falling, it would be going up. Some people say, well, maybe he just rolled these contracts. Okay, problem with that is we would see that equal volume in a different strike price, different leg, somewhere in the chain. It doesn't exist. So these options were also not rolled. So he did not add to his position. He did not roll his position. The only argument that can be made is that someone else out there that has 50,000 contracts, right? So we have Keith Gill at 120,000 contracts. We have someone else at 50,000 contracts, but that's the whole open interest of 170. And then that person that has a 50,000 contract decided to dump it today. That doesn't make too much sense also, right? The most obvious explanation for it is that it was simply him. And whether or not he dumps a bit more and exercises the rest, that we will have to see. So that's the elephant in the room in terms of, and we're going to find out soon enough. Now, also, he hasn't updated anybody. He hasn't put out a post. He might do it after market hours. Maybe by the time you're watching this, he's made it clear. He obviously reads. He sees what people are saying on Twitter, that someone is selling this, it's Keith Gill, and so on. If that wasn't the case, he would have posted an update like 2-3 minutes after the market close. And you guys know that. The fact that he didn't also affirms the fact that it was him selling. Maybe he'll make it clear, though, as to how much more he plans to sell. If I was him, it probably makes sense, right? Tell people, hey, I'm going to sell, 50,000 more contracts, because then I'm going to exercise 20,000 of those contracts. That would make sense for him to do that. Now let's talk about my positions, right? So going to the close yesterday, I had no position on. And then I decided, 15 minutes before the close, I decided to buy shares. I bought 2,500 shares. 4:30, news comes out. Offering is completed. Stock price pops up. It doesn't pop that much. I'm watching it. It's not doing much. It's barely above $30. 2 minutes after that completion was out there, I get out of it, and I end up reversing my position. Yes, I end up going short. I did grab about $1 per share of profit on my long position. I'll have the transaction up here on the side to show the profit on that. So I instantly got out of my long. I instantly got short. I also got short, where is it, at 30.64. So I'm going to bring this over now. You can kind of see what my short position looks like. So yes, I do have a short on GME right now at 30.64. This was put on yesterday after hours. Once I saw, that there wasn't much of a rally coming from the offering completion. The short is up at the moment. We can kind of see what the unrealized gain is. But what changed is my option positions. If you remember from my video yesterday, I had a put spread on that I wrote. So here's the position. I think I must have just put it on yesterday, if not the day before. I closed it. I bought it back, $10,700 in profit. That kind of adds on to the profit I had in my previous video, where I had, $174,000 in realized profits on GME. This kind of actually pushes it now to $184,000 of realized profit on GME. So that's what happened to that position. My calendar spread here, as you could see, picked up quite a bit of gains today. Now, I'm not going to put much weight on it yet because the spread is a little bit wide on a $22 leg, so I don't think it's properly quoting my P&Ls just yet. I do think I'm in the green, but I don't think I'm $11,000 in the green on it just yet, even though the potential is there. Now, a new position that I put on, and this was towards the peak of the day when GME was about $32, I did sell this straddle. So I sold the $32 call, and I sold the $32 put. I collected $20 and a half of premium, which is massive. I mean, if we chart that premium up, just to show you what we're dealing with. So this is it right here. Price is right here where this middle marker is. Break evens at expiration on the top is $52. On the bottom, it's $11. So a really nice wide range. So this straddle is actually relatively neutral of a position, right? Unlike my short shares that I have on, I would prefer to see GME actually go up to $30, right, over the course of the next couple of weeks, right? That's when I make my maximum profit. If it goes below $20, it's a little bit of profit on it, but not as much as if it actually would go up, right? With my calendar position, kind of the same thing here. I mean, again, the price is over here. As long as, I would prefer GME to be above $22 for this position, as you could see here, right? By the way it's positioned. And if I combine them two, you can kind of see, like over, $22 is where both these option positions benefit me. So these are the two option plays that I have on. Both of these are currently profitable. I'm going to hold them on, I expect, for the next couple of weeks. Since I kind of am playing the middle ground here, and I'm looking for theta burn, I can't quickly get out of them as I did with the puts because I kind of only sold one side. So obviously if price rallies, then these really deteriorate in price. In this case, it's not really so much the case. I do have to wait for the theta burn to be kicking in. Now the short position, what am I going to be doing with it, right? It's over here, 2,500 shares. Okay. I think once it becomes clear that it was Roaring Kitty that ended up selling those shares, I expect the price to dump. Now, how he deals with it is a different story. Okay, worst case scenario for the bulls. He sells his shares, sells all his options, disappears. That's the worst case scenario. I would expect price obviously plummet. Another option, keeps the shares, sells more options, exercises the other options. Okay, not bad. I think the community might be fine with that. Well, actually, let's pull away from that level. Keeps all the shares, sells all the options, right? Okay. He comes out profitable in the options. I guess the community will be impartial about it. Some will be upset because he essentially comes out profitable. Now his account's still in the hundreds of millions of dollars, but he keeps his shares. Another one, we go a little bit better. Then we have keeps all the shares, sells a few more options, but exercises the other ones, right? And I feel in that case, I think people will be most understanding of him doing that because he can say, well, how else am I supposed to do it? This is what the price is, Some people might be disappointed about it, but that is what I think he might end up doing to save face, that third option, just sell enough to the point that he can just exercise the remaining. I know people had it in their heads that he's going to be able to exercise everything and there's going to be a massive MOAS because the market makers don't have all the shares, even though they hedged them right off the bat, and we saw the price move up like crazy a month ago when he did buy them. But that's besides the point. So those are the three things. We do have the shareholders meeting tomorrow. Keith Gill typically does like to put out a meme at about 8 p.m. Eastern time after the aftermarket officially closes, so we're about an hour and 20 minutes away from that. So that time will likely come before this video is even up or before you're watching it. So maybe we'll get more color as to what is going on. That's what I have for my own positions. I'm not sure if I'll be doing anything with them, honestly, unless there's massive volatility. If we drop tomorrow down to like $18, $17, let's say, okay, I might have to do some things. Maybe adjust my current positions, maybe put on some new positions. Maybe I'll go long again. Who knows, right? We'll have to see. But that is where currently things stay. I'll try to keep you guys updated on these positions. If you're interested, just let me know. Kind of see what they end up, coming out of them. I mean, sure, listen, if I wait long enough here, right, towards expiration, which is about a month from now, maybe I can take in $60,000. But likely not, because we discussed this yesterday in my video yesterday, where implied volatility on this calendar spread, specifically on my long leg, will likely drop. So just give you guys a quick example here. I'll just pull this down a little bit. Like this, and bam, you see the whole curvature fell down a little bit, and I expect that to happen once price stabilizes a bit more. But that's basically it. I mean, if you found this video helpful, I'll give it a thumbs up. Any questions for me, leave them in the comments. I'll do my best to get back to you, and other than that, good luck out there and have a great day.